Hi, my name is Joe Halwax and I oversee the Institutional Investment Services team. At Wespath, we've been discussing what transpired in the first half of 2022 with many concerned investors and participants. It's unsettling to see your accounts have large moves up and down with the markets. Many of our valued participants are nearing retirement and are understandably concerned. This video provides an overview of the factors contributing to the market's performance as well as a little historical perspective. First, market performance. In the first half of the year, both stocks and bonds experienced losses of over 10%. U.S. stocks are down 20%, international stocks are down 19.6%, and the U.S. bond index, or what we call fixed income, is down 10.3%. It's unusual for stocks and bonds to both suffer significant losses. Typically, when stocks are experiencing sharp losses, bonds can often soften the blow. However, increased fears of inflation impacted the performance of both stocks and bonds. So that leads us to inflation. Interestingly, we are seeing signs that inflation may be close to peaking. The 5-year inflation break-even rate hit 3.59% earlier this year, but has since fallen to 2.6% at the end of June. This rate measures the market's view about the future level of inflation. The fact that this indicator has fallen implies that we should see inflation cool down over the next several years. Inflation may still be higher than what we witnessed prior to the pandemic, but investors seem to think it won't remain at record highs for too much longer. To try and slow the economy and also reduce inflation, the U.S. Federal Reserve, the central banking system of the United States, raised the federal funds rate by 0.75%. This move resulted in an increase in the cost of borrowing money across the economy, which seeks to reduce inflation by decreasing demand. This is the Fed's third rate increase this year and the most aggressive since 1994, and they intend to continue raising rates in 2022 until inflation is under control. Another issue is the fear of an impending recession. The U.S. economy, which is measured by gross domestic product, or GDP, fell 1.5% in the first quarter. On that note, the Atlanta Federal Reserve is now forecasting that the economy declined 2% in the second quarter. If this forecast is correct, the U.S. will already have entered what is called a recession, which is defined as 2 consecutive quarters of negative real GDP. Given these factors, it is no surprise that consumer sentiment is negative. Consumer sentiment measures a consumer's level of optimism as it relates to their personal finances and the economy. It's shown here in the yellow line. The University of Michigan Consumer Sentiment Index fell to 50 in June, the lowest number since the survey was launched in 1940. It is shown here in the blue line. That said, levels of extreme consumer pessimism could indicate future above-average market returns. Stated differently, stock prices that overshoot to the downside create potential for superior price appreciation from that point forward. To further support this perspective, since 1950, markets rebounded soon after consumer sentiment bottomed. Now for that historical perspective that I mentioned. The following chart shows the S&P 500's performance. The gray bars represent annual returns at the end of a given calendar year, and the red dots show how far the index fell from its highest point in that year to its lowest point in that year, which is called a drawdown. For example, at one point in 2020, the S&P 500 dropped 34%. However, the total return for that year was actually a positive 16%. Over the past 42 years, the average return for the S&P 500 was 13%. However, on average, at some point during the year, there was a decline of 14%. This is a great visual reminder that declines are completely normal, and in order to achieve overall long-term positive long-term performance, an investor needs to assume a certain level of short-term risk. We've run similar data with the Wespath Global Stock and Bond Balance Portfolio, the Multiple Asset Fund. This fund allocates approximately 65% to stock and 35% to fixed income. From this chart, we can make several key observations. Despite average intra-year declines of 10% since 2004, annual returns were positive in 14 out of the 18 total years. As of June 30th, 2022, we are in a drawdown period of 19%. Historically, this portfolio experienced larger drawdowns during the Great Financial Crisis in March 2009 and the pandemic period of March 2020. The performance recovery period took 20 months following the Great Financial Crisis, but only 4 months following the pandemic-induced drawdown. This shows that it's very hard to predict when markets will recover. Recent commentary for Dr. David Kelly of J.P. Morgan Asset Management notes that since 1946, the average recession has lasted for 10 months, while the average expansion has lasted for over 5 years. While recessions are challenging, historically they're short-lived. So what does this mean for you, our participants? Well, we believe that all investment decisions and activities must support the well-being of our participants and the missions of our institutional investment partners. In addition, clergy can take comfort knowing that life-stage invested ministerial pension plan balances have been shielded from much of the recent downturn. For those who have many years left until retirement, please note that investors that stay the course and even continue contributing to their retirements can potentially take advantage of the market's recovery. Finally, Wespath participants concerned about their financial resources in retirement can use our retirement projection tool in benefitsaccess.org at no additional cost to provide some clarity. While the economy and markets have been somewhat unnerving for the past 18 months, this is a period of post-COVID adjustment. Imbalances are being resolved, and we're adapting to a new normal, including hybrid work and more resilient supply chains. We believe that the U.S. and the world will resolve current challenges and that economic growth will resume. We hope our investors take comfort in the fact that Wespath continues to maintain a disciplined strategy of maintaining diversified investments. We will continue to closely monitor ongoing market volatility and economic factors. Thank you for your time today.